All right, today we are diving into a really fascinating corner of the financial world, Islamic structured products. This is a space where centuries-old principles are colliding with modern financial engineering, and what's coming out of it is, well, it's creating some brand new ways for people to invest.
I mean, let's be honest. Isn't this the dream for pretty much any investor? How do you get in on the market's potential gains without that constant fear of losing what you started with? This question right here, it gets to the very heart of why structured products are so incredibly popular. And this image, it just perfectly captures the whole idea. You've got your initial investment, and a big chunk of it is basically locked away for capital conservation. That's your safety net. The rest? Well, that's your growth engine. The mission is simple. Get back at least what you put in, but with a real shot at some nice gains if things go well.
Okay, so here's our game plan for today. We're going to start with the basic idea behind a structured product. Then we'll look at the conventional blueprint, how they're normally built. After that, we'll see exactly why that blueprint just doesn't work for Islamic finance. From there, we'll get into the really cool stuff, the Sharia-compliant building blocks they've come up with. And finally, we'll wrap up by looking at the challenges and innovations that are still shaping this field.
So let's start at the very beginning. What in the world are we even talking about when we say structured product? At its core, it's basically a pre-packaged investment strategy. You can almost think of it like a combo meal from your favorite bank. It bundles together a few different financial ingredients, usually some derivatives like options, but it has one key feature that really makes it stand out: the protection of your original investment. Okay, so let's pop the hood and see how a typical, non-Islamic structured product actually gets assembled. Imagine you walk in with 10,000 ringgits to invest. The first thing the bank does is take a big slice of that, let's say 8,000 ringgits, and buys a super safe zero-coupon bond. That bond is guaranteed to grow into your full 10,000 ringgits by the time the investment is over. So boom, your principal is safe. Then, with the leftover 2,000 ringgits, they go out and buy derivatives, like call options on a stock index. That's the growth engine, the part that gives you the chance for those really big returns.
Now, that all sounds pretty slick, right? But here's where we hit a wall. That conventional blueprint, as neat as it is, runs headfirst into the core principles of Islamic finance.
And here's the conflict in a nutshell. The two pillars of the conventional model are an interest-based bond and speculative derivatives. But Islamic law, or Sharia, has some very clear rules. It strictly forbids earning interest, which is known as riba. And it also forbids transactions that have a whole lot of uncertainty, called gharar, or anything that looks like gambling, which is maisir. So the very tools used to build the conventional product are just completely off the table.
This quote really nails the issue. The problem with a lot of derivatives, from a Sharia perspective, isn't just that they're complex. It's that they often create a zero-sum game, where for you to win, someone else has to lose, and it's all based on pure speculation, not on creating any real economic value. That's what's seen as being way too close to gambling.
So, if you can't use interest-bearing bonds and you can't use conventional derivatives, what do you do? How do you even begin to build a product that can protect capital and offer growth? Well, this is where we see that Islamic finance is all about innovation that's born out of these constraints.
This is the first massive puzzle that had to be solved. How do you get that same, safe, predictable growth of a bond to protect an investor's principal, but without using any instrument that pays interest? So one of the solutions is a contract called Buy Al-Ina. Now, it's a bit of a mind bender, but think of it this way. The bank sells an asset to you on credit for, say, 110 ringgits. Then, in the next breath, it buys that same asset right back from you for 100 ringgits in cash. So you get the cash you need now, and you owe the bank 110 ringgits down the road. It creates a debt, but without ever mentioning the word interest.
Now, a much more widely accepted approach is something called tawarruk. It starts out similar, but there's one massive difference. After you buy the asset from the bank on credit, you turn around and sell it for cash to a completely different company, a third party. Because the asset actually goes out into the open market and doesn't just circle back to the bank, most scholars see this as a series of legitimate trades, not just a workaround for a loan.
And this table just lays it out, crystal clear. Al-Ina is a closed loop, just two parties. Al-Tawarruk breaks that loop open by bringing in a third party. It makes sure the asset actually goes somewhere else. And believe me, that distinction is absolutely crucial for why it's so much more accepted globally.
Okay, so we've figured out a Sharia-compliant way to secure the principal. That's a huge step. But what about the other half of the equation? The part that's supposed to generate those exciting returns? How do you create something that acts like an option without breaking any of the rules? Well, the answer comes from a classical Islamic contract called urban. The easiest way to think about this is like putting down a non-refundable deposit on something you want to buy. You pay a little bit of money now to lock in the right to buy an asset at a set price in the future. If you go through with the purchase, great. Your deposit just becomes part of the price. If you decide to back out, you only lose the deposit.
Now, when you put them side by side, you see some really important differences. With an urban, that deposit you paid actually becomes part of the final price. It isn't just a fee to buy a contract. And here's the big one. You can't trade the urban right itself. You can only use it or lose it. This completely prevents that secondary market speculation that is such a big concern in Islamic finance.
But you've got to remember, none of this is set in stone. This is a living, breathing field, and there is a very real, very active debate happening among Sharia scholars about all of these instruments. So on one side, you have groups like the Sharia Advisory Council in Malaysia. They've taken a pretty pragmatic view, and they've decided that certain futures contracts, like for crude palm oil or for certain stock indexes, are actually permissible. And that's likely because they see a genuine economic need for companies in those industries to hedge their risk.
But then, on the other side of the debate, you have giants in the field like Mufti Taqi Usmani, who holds a much more cautious view. His argument is that since most people trading futures never actually intend to take delivery of the oil or the stocks, they just want to settle up on the price difference. It doesn't represent a true sale. And in his view, that makes it invalid.
And this ongoing debate is really just one of several major hurdles. So let's take a quick look at the biggest challenges and the innovations that are really shaping the future for these products.
You know, putting these products together is a serious balancing act. For example, some of the strictest standards prohibit guaranteeing any returns, which makes capital protection pretty difficult. The scholarly debates we just talked about, that creates liquidity risk. A product might be perfectly fine in Malaysia, but completely unacceptable in the Middle East. And because it's all so new, there's a huge legal risk, since many of these complex structures have simply never been challenged in court.
Which really leaves us with one final big question. As the whole world of finance continues to evolve and grapple with risk, what can be learned from this approach? An approach that is fundamentally about avoiding too much debt, tying finance back to real assets, and sharing risk in a more ethical, equitable way. It's definitely something to think about.